Canada's oil empire is breaking free from America's grip. It was losing billions every year to a single buyer. Now, a pipeline is turning that loss into global power. Canada stands as an oil colossus, pumping 4.9 million barrels of crude daily in 2023, a volume that could fill 720 Olympic-sized swimming pools. Yet, 97% of its oil exports, 3.8 million barrels per day, flowed to a single buyer, the United States. This arrangement, at first glance, resembled a robust trade partnership, a handshake across the world's longest undefended border. But beneath the surface, it was an economic straitjacket, binding Canada's wealth to American whims. The dependency was suffocating. Producers like Suncor, Cenovus, and Canadian Natural Resources were tethered to U.S. refineries, forced to sell into a market that dictated terms. The lack of global market access meant brutal discounts, with Western Canadian Select, WCS, often trading $20 to $30 per barrel below international benchmarks like Brent. In 2023, these discounts drained billions in revenue, funds that could have bolstered schools, hospitals, and infrastructure across Canadian communities. The math was stark. A $30 discount on 3.8 million barrels daily equates to over $41 billion CAD lost annually, a hemorrhage that exposed the fragility of Canada's energy economy. The root cause was infrastructure, or its absence. The original Trans Mountain Pipeline, built in 1953, was a relic of a bygone era, designed for a Canada producing far less oil. By 2023, oil production had surged 40% in a decade, driven by the Athabasca oil sands' rise as a global energy powerhouse. Yet, pipelines remained stubbornly southward, funneling crude to U.S. refineries in Texas and Illinois, not west to the Pacific or east to Europe. Canada's energy economy was a caged eagle, its wings clipped by geography, outdated infrastructure, and reliance on a single buyer. This dependency wasn't just economic, it was strategic. Canada's lack of options left it vulnerable to U.S. policy shifts, a reality that crystallized in 2025 when the U.S. proposed a 10% tariff on Canadian energy imports. The threat sent shockwaves through Calgary's oil towers and Ottawa's halls of power. For Canadian producers, the tariff risked billions in losses, threatening jobs and economic stability. For the U.S., the move was a double-edged sword. Midwest refineries, built to process Canada's heavy crude, faced no easy substitute. Retooling for lighter blends could cost hundreds of millions per refinery and take years, exposing a mutual vulnerability. This wasn't a partnership. It was a precarious dance, with both nations locked in a delicate high-stakes embrace. The stakes were undeniable. Canada had to diversify or drown. To break free, it needed access to global markets, Asia's booming economies, Europe's steady demand, anywhere but south. The solution was clear: expand the Trans Mountain Pipeline, tripling its capacity to 890,000 barrels per day and forging a western gateway to the Pacific. This wasn't just about moving oil, it was about reclaiming control, shattering a half-century of dependence and building a future where Canada could dictate its own terms. Canada built a pipeline to conquer the world's toughest terrain. It took a decade and $25 billion to tame the Rockies. The real battle wasn't rock, it was resistance. To escape its economic cage, Canada had to conquer nature itself. The Trans Mountain expansion was a 1,150-kilometer gauntlet stretching from Edmonton's Athabasca oil sands to Burnaby's Westridge Marine Terminal on the Pacific coast. This wasn't a project, it was a war against geography, pitting human ingenuity against mountains, rivers, and relentless time. Proposed in 2013 by Kinder Morgan, the plan seemed deceptively simple: lay a second pipeline alongside the original, tripling capacity from 300,000 to 890,000 barrels per day. But simplicity was an illusion. The route demanded engineering feats that tested the limits of technology and endurance. In Alberta, engineers navigated wetlands and farmlands using horizontal directional drilling, a technique akin to threading a needle beneath the earth. Guided by GPS and sensors, pipelines were installed deep underground, sparing fragile ecosystems and minimizing surface disruption. This method wasn't just innovative, it was a lifeline for environmental stewardship, balancing progress with preservation. The Rockies, however, were the true adversary. In British Columbia's Fraser Valley, construction crews faced landslides, unstable cliffs, and avalanches that turned work sites into battlegrounds. Progress crawled at meters per day, each blast of rock requiring meticulous reinforcement. Steel anchors were drilled deep into cliff faces, paired with erosion controls and reinforced walls to prevent mountains from collapsing onto the pipeline. In 2022, a slope failure near Jacko Lake halted construction for weeks, a stark reminder that nature yields only to relentless determination. Workers endured sub-zero temperatures and brutal winter storms, their resolve forged in the crucible of the wilderness. Westward, the project twinned 200 kilometers of the 1953 pipeline, reactivating dormant lines with painstaking upgrades to meet modern standards. New pumping stations were built, and specialized welding crews worked around the clock, ensuring oil could flow seamlessly across the vast distance. At the Pacific, the Westridge Marine Terminal was transformed into Canada's west-facing energy fortress. Engineers expanded it to include 3 deep-water tanker berths, 19 high-capacity storage tanks, and state-of-the-art spill prevention systems, positioning it as a global hub capable of serving markets from Shanghai to Rotterdam. By May 2024, the final weld sealed a decade of grit. The pipeline was flushed, pressure-tested, and brought online, tripling Canada's export capacity overnight. Every kilometer told a story of resilience, from tunneling beneath salmon-rich rivers to defying avalanches. This wasn't just infrastructure, it was Canada's declaration of independence, etched in steel and sweat. The journey was fraught with resistance. Environmental protests, Indigenous land rights disputes, and legal challenges stalled progress from 2014 to 2018. Concerns over ecosystem protection and land sovereignty were valid, sparking nationwide debates. Permits were revoked, protests disrupted work sites, and Kinder Morgan, overwhelmed by escalating risks, abandoned the project. It teetered on collapse until the Canadian government intervened, purchasing it for 4.5 billion Canadian dollars in 2018. This wasn't a business deal. It was a national mission, a commitment to secure Canada's energy future. Construction resumed in 2019, driven by a resolve to overcome both nature and politics. Canada's pipeline is rewriting its economic destiny. It's injecting $24 billion a year into the economy. But the real win is global influence, not just cash. When the Trans Mountain expansion came online, it didn't just move oil, it unleashed an economic tsunami. Export capacity soared from 300,000 to 890,000 barrels per day, creating a high-speed highway to global markets. For the first time, Canadian crude bypassed congested U.S. pipelines, sailing directly to Asia, Europe, and beyond. The pipeline didn't just open a route, it opened a new chapter in Canada's economic history. The impact was immediate and profound. In 2023, Canada exported 4.8 million barrels daily, a 3.4% increase from 2022, valued at 124 billion CAD, 16% of the nation's total exports. With TMX operational, projections estimate an annual 9.2 billion Canadian dollars boost to Canada's GDP, a figure that underscores the project's transformative power. Over the next 20 years, oil producers are expected to earn 73 billion Canadian dollars in additional revenues, while federal and provincial governments will collect 46 billion Canadian dollars in taxes and royalties. These aren't abstract numbers. They're the lifeblood of a nation, funding infrastructure, healthcare, education, and opportunity. The human toll was equally significant. The project created 38,000 jobs, a lifeline for communities across Alberta and British Columbia. Of these, 3,600 were filled by Indigenous workers, marking a step toward economic reconciliation. Over 6 billion Canadian dollars in contracts were awarded to Indigenous-owned businesses, transforming the pipeline into a bridge to prosperity for communities long marginalized. For many, this wasn't just a pipeline, it was a pathway to partnership and self-determination. The true prize, however, was access to global markets. Between May and November 2024, China purchased 2.3 billion Canadian dollars in Canadian crude, signaling Asia's growing appetite. Europe followed suit, with Spain, the Netherlands, and other nations importing 6.7 million metric tons in 2023. India, with its energy-hungry economy, emerged as a new frontier, poised to become a major buyer. Canada wasn't just selling oil, it was selling options, negotiating from a position of strength rather than desperation. The days of discounted sales were over. The pipeline had rewritten the rules of trade. This was energy sovereignty, a Canada no longer chained to a single buyer. The Trans Mountain expansion didn't just reroute oil, it rerouted influence, securing Canada a seat at the global energy table. But as tankers sailed to new horizons, a shadow loomed over the U.S. Canada energy axis. The pipeline's success was a triumph for Canada, but it posed an unspoken challenge to its southern neighbor, threatening to upend a partnership that had defined North American energy for decades. Canada's pipeline is shaking up global energy politics. It's challenging America's dominance overnight. Yet it's not war, it's a bold new balance. For over half a century, Canada's oil economy operated on a single, unspoken assumption. The United States would always be the buyer. 97% of Canadian crude, 3.8 million barrels daily, crossed the southern border, a predictable, profitable rhythm that shaped both nations' economies. But predictability bred complacency, and Canada didn't control the terms. The U.S., as the dominant buyer, held the whip, and Canada was at its mercy. This reality shattered in 2025 when the U.S. proposed a 10% tariff on Canadian energy imports. The announcement sent tremors through Canada's oil industry and beyond, exposing the fragility of a relationship taken for granted. For Canadian producers, the tariff threatened billions in losses, jeopardizing fears of economic fallout, lost jobs, shuttered projects, and weakened communities. For the U.S., the move was a gamble with its own risks. Midwest refineries, purpose-built to process Canada's heavy crude, faced no quick alternative. Switching to lighter blends would require hundreds of millions per refinery and years of retooling, potentially disrupting supply chains and raising fuel prices. This wasn't trade. It was a high-stakes chess game, with both nations locked in a tense, interdependent stalemate. But Canada had already laid the groundwork for its countermove. The Trans Mountain expansion was a pivot, not just a pipeline. By connecting Alberta's oil fields to Pacific ports, Canada gained leverage it had never possessed. Crude could now sail to Shanghai, Rotterdam, or Mumbai, bypassing U.S. pipelines and sidestepping tariff threats. This wasn't about abandoning the U.S. It was about refusing to be boxed in. For the first time, Canada could negotiate from strength, not need, diversifying its energy diplomacy without burning bridges. Canada's new energy strategy is a tightrope walk. It seeks global markets while maintaining ties with its largest trading partner. But the U.S. is watching closely, and the shift hasn't gone unnoticed. As Canadian tankers chart new courses, American refineries in Texas and Illinois face an uncomfortable question. What happens when your most reliable supplier diversifies? This isn't a divorce, it's a rebalance, but it carries the seeds of tension. Canada remains a partner, but it's no longer a captive, and the pipeline has flipped decades of energy trade dynamics, forcing both nations to reassess a relationship once thought unshakable. Canada's pipeline is redrawing the global energy map. It's making the U.S. rethink its energy security, but it's also lifting communities and nations alike. The Trans Mountain expansion is more than Canada's story. It's a global one. By tripling export capacity to 890,000 barrels per day, Canada has redrawn the energy map, challenging the foundations of North American trade. Global oil demand is surging, particularly in Asia, where economies like China and India are ravenous for supply. Canada is now a player, not a pawn, with the infrastructure to meet that demand and the flexibility to choose its buyers. But every action sparks a reaction. As Canada courts new markets, the U.S. faces a subtle but real threat. Losing even a fraction of Canadian crude could disrupt supply chains, elevate fuel prices, and strain an economy already wrestling with energy costs. This isn't about rivalry, it's about reality. Canada's independence forces the U.S. to confront its own vulnerabilities, particularly its reliance on a neighbor no longer bound by necessity. The tariff threat of 2025 was a wake-up call. underscoring that interdependence cuts both ways. Yet, the pipeline's legacy transcends geopolitical tension. Its 38,000 jobs, $6 billion CAD in indigenous contracts, and a projected $24 billion CAD annual boost to GDP. It's a Canada that negotiates with options, not obligations, wielding influence as freely as it moves oil. For Indigenous communities, the project has been a catalyst for economic empowerment, fostering partnerships that could reshape Canada's social fabric. For the nation as a whole, it's a beacon of sovereignty, a testament to what determination and vision can achieve. The ripple effects extend beyond borders. Global markets are shifting, with Canada's entry as a diversified supplier altering trade flows and pricing dynamics. The pipeline has given Canada a voice, one that resonates from Calgary to Beijing, from Vancouver to Brussels. But with that voice comes responsibility, to balance profit with environmental stewardship, to honor Indigenous partnerships, and to navigate tensions with a neighbor that remains both ally and competitor. U.S. tariffs are shaking corporate America to its core. Companies like Target and Costco are rewriting supply chains overnight, but Canada's pipeline gives it a shield in the trade war chaos. The U.S. tariff storm, ignited by President Donald Trump's 2025 trade policies, has sent corporate America into a frenzy. A 10% tariff on Canadian energy imports, alongside 25% levies on other Canadian and Mexican goods, has forced companies to rethink supply chains and pricing strategies. The Trans Mountain expansion, by contrast, positions Canada to weather this storm, offering a lifeline to global markets that bypasses U.S. tariff threats. Retail giants are scrambling. Target, heavily reliant on Mexican produce like vegetables and fruit during winter, warned of price hikes if the 25% tariffs persist. CEO Brian Cornell noted that a 25% tariff could drive up costs, with price increases inevitable within weeks. To mitigate, Target is shifting sourcing for its store brands, such as All in Motion and Cat & Jack, from China, where 30% of these products originate, to countries like Guatemala and Honduras, aiming to reduce China dependency to 25% by 2026. This pivot is a direct response to Trump's escalating tariffs, including a 34% hike on Chinese goods, bringing total levies to 54% in early 2025. Kroger, a major U.S. grocer, is diversifying its supplier base to shield its fresh business from tariff impacts. CFO Todd Foley emphasized shifting to geographies less affected by tariffs to keep prices low, a strategy driven by the unpredictable tariff landscape, with levies on Canada and Mexico paused temporarily after negotiations, but set to resume if border enforcement talks falter. Costco, with its flexible treasure hunt merchandise mix, is better positioned to source from non-tariffed countries, but even it faces supply chain disruptions as Canada's energy exports, critical for U.S. refineries, face tariff uncertainty. The corporate scramble highlights a broader economic truth. Trump's tariffs, designed to bring manufacturing back to the U.S., are creating chaos. The 10% baseline tariff on nearly all countries, with higher rates for China, 34%, the EU, 20%, and India, 26%, has pushed U.S. trade duties to their highest since the Great Depression. Companies face a dilemma: absorb costs and slash profits or pass them to consumers, risking inflation. Canada's Trans Mountain expansion, however, is a game changer, allowing it to redirect oil to Asia and Europe, sidestepping U.S. tariffs. Between May and November 2024, China alone bought $2.3 billion CAD in Canadian crude, proving Canada's ability to pivot. This isn't just survival, it's strategic defiance. While U.S. companies grapple with tariff-induced uncertainty, Canada's pipeline offers a shield of sovereignty, enabling it to negotiate from strength. As corporate America scrambles, Canada's energy independence is a quiet victory, reshaping trade dynamics and exposing the limits of U.S. tariff leverage. Canada's pipeline is riding a global financial wave. Trump's tariffs are tanking the U.S. dollar's dominance. Europe and Canada could seize the moment to reshape trade. The Trans Mountain expansion didn't just open oil routes, it positioned Canada to capitalize on a wobbling U.S. dollar, shaken by Trump's volatile tariff policies in 2025. The U.S. dollar, long the world's reserve currency has lost ground, with its main index, DXY, dropping roughly 10% since Trump's January 20, 2025 inauguration. This decline, driven by tariffs like the 10% levy on Canadian energy and 34% on Chinese goods, has sparked a global search for alternatives, with Europe's euro poised to gain and Canada's energy exports finding new financial leverage. Trump's trade war, including a 22% average tariff rate on all U.S. imports, has disrupted global markets, pushing investors to question the dollar's reliability. The White House's clash with the Federal Reserve and courts, coupled with advisor Stephen Moran's public doubts about the dollar's reserve status, has fueled uncertainty. Shell-shocked investors are deserting the greenback, creating an opening for Europe to advance the euro as a rival. The EU is eyeing a Eurozone-safe asset to challenge U.S. Treasury bonds, a move that could reshape global finance. Canada's pipeline is a financial lifeline in this chaos. By enabling oil exports to Asia and Europe, 6.7 million metric tons to Spain, the Netherlands, and others in 2023, Canada can trade in diverse currencies, reducing reliance on a faltering dollar. The 2.3 billion Canadian dollars in Chinese crude purchases in 2024 signals a shift toward markets less tied to U.S. financial dominance. This flexibility strengthens Canada's position as a global energy player, capable of navigating a world where the dollar's reign is under threat. Europe stands to benefit, but so does Canada. The EU's push for financial autonomy, driven by tariff-induced uncertainty, aligns with Canada's energy diversification. As the U.S. dollar wobbles, Canada's pipeline becomes a strategic asset, allowing it to forge trade ties with euro-based markets and beyond. This isn't just about oil, it's about influence, with Canada leveraging a shifting financial landscape to assert its sovereignty. The U.S., meanwhile, faces a self-inflicted wound, as its tariffs undermine the dollar and push allies like Canada toward new economic horizons. The Trans Mountain Expansion is Canada's Emancipation Proclamation, a saga of steel and strategy. It has shattered dependency, granting Canada freedom to chart its course. But freedom brings friction. As Canada sails to new markets, the U.S. navigates a partnership no longer guaranteed, compounded by tariff chaos and a weakening dollar. Corporate America scrambles, and global finance shifts, with Canada's pipeline as a beacon of resilience. You've seen the playbook behind the headlines. Now stay ahead of the game. Subscribe to decode the moves shaping tomorrow's world, from trade wars to tech revolutions. Join the 1% who don't just watch the news but understand it. Hit that button, share this video, and follow us for the stories others miss. The next shift is coming. Will you see it first? Let's unravel the future together, one silent victory at a time.